Welcome everyone to our 2023 mid-year Nicola Wealth Real Estate webcast. My name is Mark Hanna and I am the Managing Director for Nicola Wealth Real Estate. For this webcast, I will be serving as the moderator. This webcast is approximately 60 minutes in duration, where we will be reporting on the performance of our 3 real estate LPs and on the various areas of specialty of our real estate team. Speaking of our real estate team, we are enhancing our format for this webcast. We have 9 presenters from our Nicola Wealth Real Estate team presenting on various topics. Our team is fully integrated and totals 65 people, comprising a wide range of expertise and specialization. This revised format allows us to showcase our talent and their passion for achieving great outcomes for our clients. It reinforces why experienced people make a difference managing real estate. So let's get started. I would now like to welcome Alex Messina, who's Vice President of Acquisitions. Alex is going to talk about the returns for all 3 real estate limited partnerships. Alex, over to you.
Thanks, Mark. We recognize that there have been challenges in this current environment. Interest rates have risen over the last year. So with that, I'm pleased to report that each of our funds have delivered positive returns for the first half of the year. In the chart on the screen, you can see how each of our 3 funds have performed for the year to date to June 30th. Our Canadian fund, Nicola Canadian Real Estate LP, has delivered a 3.3% return. Nicola US Real Estate LP is at 4.3%, and Nicola Value Add Real Estate LP is at 3.2%. Although these figures suggest that returns this year will be lower than last year, it's important to remember that each of these funds are designed to be long-term investments. And so while we measure ourselves on annual performance, there will naturally be some variation from year to year. And it's important to recognize long-term performance, which we've shown in the far right-hand column of the chart. In the next few slides, I'll walk through the historical performance of each fund, starting with Nicola Canadian Real Estate LP. You can see that this fund has delivered a consistent return averaging 9.7% per annum since inception. As a reminder, all of our funds are open-ended evergreen funds. The return composition for this fund is derived from rental income as well as asset appreciation. And you can see that 2021 and 2022 were record years for performance. This was a result of our push to acquire industrial assets in the GTA market where we saw tremendous rental rate growth, and this in turn drove property valuations. Going forward, we continue to experience rental rate growth in this sector. This, in fact, is also helping to counterbalance the impact of rising interest rates. Self-storage and multifamily rental assets also continue to experience strong rent growth, so you can see why these 3 assets are our core areas of focus. Shifting now to the U.S. fund, Nicola US Real Estate LP, you can see that this fund has delivered a consistent return of 11.7% per annum since inception. And similar to the Canadian fund, the return composition here is also derived from both income and asset appreciation. And like the Canadian fund, the U.S. fund delivered strong returns in 2022. In this case, this was a result of strong rental rate growth for the multifamily and industrial assets within this portfolio. And lastly, for Nicola Value Add Real Estate LP, this fund has delivered a 14% return since inception. Given this is a merchant fund, the return is mostly comprised of capital appreciation, or in other words, value creation, and has less income as assets are sold once the strategy is complete. There were a few strategic sales in 2022 that contributed to a strong return. For 2023 so far, our return has been a little bit lower. This is mainly a result of longer project timelines and some cost pressures. However, we expect a strong second half performance as we have better sightlines on our projects.
Now, Alex, I realize that you don't have a crystal ball, but now that we're at the halfway point, I'm going to ask you to stick your neck out. What are you projecting for the balance of the year for all 3 real estate LPs?
So now that we've completed the first half of the year, here are some general thoughts on what we expect for the rest of the year. So in this environment, rising rates continue to put pressure on valuations as cap rates rise. We have a strategy to defend against this, and it's really to focus on asset classes that have rental rate growth. As I mentioned, this means an emphasis on multifamily rental, industrial, and self-storage. Now for the hot topic for returns for the rest of the year, we certainly expect a reversion to the mean or long-term average. This could mean that returns fall in the mid to high single-digit range for all 3 funds, which I think is a very reasonable result in this environment. And the last point I'll make is just to reinforce the long-term nature of what we do. We're confident in our fund composition and our team strategy. You can see it's paying off in this environment, and we think there will be a lot of runway in the next few years.
That's a great summary. Thank you, Alex, for your presentation on the performance of all three of our real estate LPs. I would now like to invite Matt Schaeffers, who is Director of Acquisitions in the US, and he'll be presenting on fund composition and investment themes. So Matt, let's start with the first question. Why is fund composition important?
Fund composition is important because not all real estate is created equal. And as we're seeing in the current market cycle, certain locations are struggling and others are doing well. And more particularly, certain asset classes are really struggling and some are doing well. Office versus industrial and multifamily. As you can see within our fund composition, the majority of our funds, Canada is 37% industrial, 9% multifamily, but that development 20% is predominantly industrial. And in the US, the fund composition is 53% multifamily, 21% industrial, and the development piece is industrial. So we're very heavily weighted within multifamily and industrial, and those asset classes are performing really well.
So Matt, our team is very focused on getting great results for our investors. Can you explain to our audience, how do we find alpha returns?
Alpha returns within our team are driven by a very strict and disciplined investment criteria, and we're evaluating many things when we're looking at an investment. We're looking at the city, the submarket, the location within the submarket, the asset class, the building's bones and features, and the utility of the asset to lease to tenants and have a durable income stream. Historical vacancy trends and current environment are also very important, and we're not ticking these boxes in isolation. We're talking to our debt team and leasing team and our asset management team. So it's a very collaborative approach, and a big box we're looking to tick is the opportunity for value creation over the short to medium term. If there's nothing to do and the asset is fully stabilized for the long term, it's a pass. And if we can't tick all these boxes and add value to the asset with our team, it's a pass. So it's a very disciplined analysis and a collaborative process.
Matt, we have purposely built a diversified real estate portfolio for all three funds. Can you expand on the various markets and how we make those decisions?
Going to markets is a similar process of ticking boxes. We're looking for markets with strong population growth, favorable tax environment, good hospitals, universities, a good economic story, presence of Fortune 500 companies, strong labor market, historically low vacancy rates, and also good investor demand and high liquidity. Now, not all markets tick all boxes, but we're looking for a confluence of as many of those factors. And so in Canada, we're in Vancouver, Victoria, Kelowna, Toronto, and the GTA, and as well Calgary and Alberta. And in the US, we're in Seattle, Phoenix, and Vegas, the Sun Belt, Texas, Denver, Minneapolis, and in the south and southeastern states with our multifamily portfolio with Venterra.
So Matt, on the same theme of diversification, can you describe how we select various asset types in the target markets?
Going into our target markets and selecting assets, our focus is really multifamily industrial, as stated, and self-storage. We're looking at creative office and single-story low-rise office and flex industrial. All of these assets share a common theme, which is low operating capital requirements and low tenant releasing costs. Within the U.S., you see a similar asset classes and investment theme, the small and mid-bay industrial, build-to-own industrial, IOS sites, industrial outside storage. They're a subset of industrial. Great location. On these assets, we're deriving income from both the building and the land, and in irreplaceable locations. So great opportunity for rent growth. And similarly, the covered land plays, self-storage, and the multifamily. So again, similarly, multi-tenant rent rolls, low ongoing operating costs and capital requirements, and strong locations garnering great tenant demand.
And finally, Matt, our value add fund is a pure merchant fund that operates on both sides of the border and specializes in repurposing, build to sell, lease to sell. Can you give us a little bit more background on the themes for our value add fund?
Our value add fund, shown here on the slide, are the broader investment themes, which include small bay, strata, and condo, where we're building ground up with a partner and selling individual strata units, industrial repositioning, which are a great opportunity or a great investment where we're entering at an attractive basis, enjoying income through the hold, a little capex, and sell the finished stabilized asset. Buy bulk, sell the parts, buying a portfolio, breaking it up, selling it then to smaller owner users, and multifamily rental development and repositioning. Like ourselves, we're building these assets because they're very expensive to buy. If we build from the ground up or reposition old, there's great liquidity on an exit. And then multifamily condo development, where townhouse or high mid-rise multifamily, build with the developer, and we'll sell the individual units. It's a similar process as our acquisition strategy, where we're ticking boxes, but in the value add fund, we're also ticking the box. Do we like the partner? Has there been success in the past with the partner? Do we like the strategy? And is there an appropriate risk-adjusted return for the deal?
Thank you, Matt, for your presentation. I would now like to invite Shaun Blythen, who will be presenting on property valuations and our NAV policy. Shaun is Director of Acquisitions in Canada and leads our property valuations. Shaun, let me start first with, why are property valuations under the microscope?
Well, there's been a lot of news headlines lately that's stating commercial real estate is in trouble. There's a range of reasons as to why this may be true, such as rising interest rates, work from home, fund redemption requests, the list goes on. And while this may ring true for certain asset classes and specific geographies, such as downtown office, for example, and many major cities which are feeling the impact from remote and hybrid work policies, I mean, not all funds are created equal. These larger scale office investments have a limited buyer pool. Older product may not lend itself well to kind of a green or sustainable upgrade, and which is becoming increasingly more important for investors. And we talk about fund composition in this webcast, and that's why we have a diversified fund. If you peel back the layers of the headlines, most of them state office is in trouble. A certain asset class and a certain geography, which is why we have numerous asset classes in multiple geographies. And while we can't control cap rate expansion, we can control how we manage our assets and have been able to push income growth to offset any increase in yields.
Shaun, there's been a lot in the media about REITs and their underperformance in the public markets. What is your view on why REITs are undervalued?
I mean, it's a hot topic, and we have lots of questions about this specifically. What it really boils down to is the volatility of the pricing and the liquidity of the product itself. Public REITs trade daily on an open market, which daily liquidity versus the private REIT, which has a lot less liquidity. The underlying real estate, all things being equal, is still the same value, but that market sentiment is the main reason why there's the disconnect between that REIT NAV versus what would be the true underlying value of the real estate. There seems to have been a bit of a shift lately in the real estate landscape with the emergence of more non-traded REITs. And there was an announcement this week that Bentall Green Oak has launched a new industrial non-traded REIT. And interestingly enough, I read this week, 2022 in the US specifically, it was the first year since 2001 that no companies filed to become a public REIT. And in fact, many long-standing REITs went private and taken private by large groups such as Blackstone and Prologis. So it really boils down to that liquidity and the volatility in the market. And for the reasons I mentioned previously, interest rates, work from home, redemption requests, with investors looking for less volatility, they're moving towards those non-traded REITs versus the public REITs.
And Shaun, finally, for private assets, property valuations are under a lot of scrutiny. Can you explain to our audience what the appraisal process is for Nicola Wealth Real Estate?
We appraise our entire portfolio every quarter, with a third of the portfolio being appraised each month. We use best-in-class appraisal firms in different markets across Canada and the US. The reports come in from the appraisers and are reviewed by the entire team, starting with asset management, reviewing their portfolio, and filters through investment, and ultimately to myself to review to ensure accuracy in leasing and yield conclusions, and making sure that assets aren't over or undervalued and are accurate as possible. It's been a challenging environment for appraisers lately, given the lack of comparable transactions and data points, so sentiment has started to play a bigger role in the value conclusions of appraisers. And with rising interest rates and yield spreads, we have seen some expansion in yields. But thankfully, as I've mentioned earlier, we've been able to offset that expansion by driving the income growth, and we're seeing rental growth and the way our portfolio has been created. The debt is not a factor in our appraisals, and all assets are appraised as if unencumbered from debt, and we do not mark to market our existing debt. At the end of each year, every appraisal is reviewed by Baker Tilly, our auditors, and we produce audited financial statements. And we also benchmark, submit our data to MSCI for RealPAC in Canada and the various US indexes.
Thank you, Shaun, for your presentation.
I'd like to now invite Matthew Middleton. He'll be presenting on mortgage debt and the interest rate environment. Matthew is Director of Real Estate Debt. So Matt, let's start off with, can you walk us through the current lending environment and how our real estate funds are positioned?
Absolutely, Mark. There's really four key themes that we're seeing in the debt capital markets today. And so I'll briefly walk through each theme and how our funds are positioned. So to no surprise, the first one is higher base rates. We've seen a rapid increase in base interest rates that's resulted in higher borrowing costs for both fixed rate and in turn floating rate debt. Over the past year and a half, we've seen in Canada at least the prime rate go from 2.5% to north of 7%. We've seen 5-year Government of Canada bond yields, which are used to price commercial mortgages, go from 1.5% to close to 4% where they trade today. That being said, not every fund or real estate portfolio is the same. Our funds, our income funds, are primarily composed of fixed rate debt. This allows us to have greater cash flow certainty and also minimizes the impact to the higher rate environment on our portfolio. And number two, I'll talk about this a little later on, but we have an active debt management strategy with the focus on de-risking our loan portfolio. The second theme is a focus on quality. We've seen asset class, asset quality, and sponsorship are more critical than ever. Lenders are focused on these aspects. Our portfolio is defensively positioned and comprised of multifamily rental, industrial, and self-storage. These asset classes remain desirable for lenders to finance, and in turn allows our debt team to procure optimal financing terms for our investors. The third theme we've seen is defensive underwriting. There's an enhanced reliance on cash flow and debt service coverage as the primary loan sizing constraint. This has become more evident as interest rates have increased. Our portfolio, as you know, Mark, is primarily composed of cash flowing assets. This allows us to refinance assets in today's environment, also going forward, given the inherent cash flow growth we have in a substantial portion of our portfolio. And the fourth factor, and this has become really more prominent over the past 6 months, and I think has really been spurred by the U.S. regional banking crisis that happened earlier this year, but we've seen a material shift where lenders are now focused on servicing existing clients and groups of strong management teams. Our debt team holds extensive relationships with a wide range of lenders in both Canada and the US, and this in turn allows us to obtain a diverse set of debt capital for our properties and projects. So just tying this all together, Mark, we believe the current lending environment favors real estate operators with high quality balance sheets, cash flowing asset bases, and strong relationships with lenders.
Matthew, real estate debt plays a very important role in getting optimal returns for our investors. our team often talks about fund composition. Can you explain why debt composition also is important?
Yeah, Mark, there's really, this slide shows our two income funds. There's really three core factors we look at when it comes to debt composition. And the first one, I touched on this a little earlier, but the first one is interest rate composition. And so you can see here for both our income funds, the bulk of our portfolio is comprised of fixed rate debt. So you can see for our Canadian income fund, about 65% of our loan portfolio is fixed. For our U.S. income fund, close to 90% or just over 90% of the loan portfolio is fixed. Just speaking specifically on the Canadian portfolio for the income fund, that a slightly higher variable rate exposure is largely due to our development portfolio. And I'll talk to you a little later on a strategy we're looking to deploy to help manage that floating rate risk. The second factor we look at is maintaining a prudent leverage ratio. You can see here for both of our income funds, we're below 50%. And just taking a quick step back, as you know, Mark, we view debt as a complementary piece to our returns. It's ultimately not the sole driver of returns. What ultimately drives our returns is buying properties in strong markets, good locations, good functionality, and the ability to grow cash flows. And so we view debt as a complementary piece, not the sole driver of what really drives our returns. The third factor is, really a balanced debt maturity profile. So you can see here for Canada on the left, US on the right, we ensure we have a balanced maturity profile. So you can see here that really the highest exposure in any 1 year is call it 20% and below. And so the idea of this is really it allows us to minimize the impact in any 1 year to the credit environment and the interest rate environment.
Matthew, that's a really great slide for our investors because that's a very common question that we get asked about our debt exposure for both income funds. In this high interest rate environment, Matthew, how do you prepare for this lending and landscape? And what strategies are you and your team implementing?
Yeah, so Mark, I talked about active debt management earlier, so this touch on a little more. There's really three kind of key pillars we look at, and the first one is focusing on de-risking our loan portfolio, and I'll talk about that in a second here. The second one is cash flow certainty. I spoke on that with regards to having a higher proportion of fixed rate debt, and the last one is a capital recycling program, and we see this as an ability to create value for unit holders by really generating a meaningful amount of equity or capture on our refinancing. So I'll touch on a couple examples of this. So there's really three strategies. The first two, blend and extend, and a tactical early refi. These are two strategies we actively deployed before the run-up in rates. And the third one, a forward rate fixing, is something we're looking to put in place today. So this is a blend and extend we did on our Joshua Creek property in Oakville. We did this in early 2021. And so at the time, Mark, we looked at this property, and there was about 2 years of term remaining, at a really favorable rate of, call it 3.1%. At the time, we were in obviously a very low rate environment early in 2021. We're also in an accommodative credit environment. So, we saw this as an opportunity to really de-risk this particular loan and buy out some additional term, and that's what we did. So just walking through the metrics of the transaction, we increased our original loan from 19 million to 27 million. We obtained a new low fixed rate of 3.2%. We took our remaining 2 years of term and blended it with a new 5-year term. So in essence, we obtained a net new 3 years of term. And then we also obtained an extended 25-year amortization, which allows us to enhance the cash flow after debt on this property. So just tying this back together, looking at the merits of this financing, we secured a new low fixed rate, we procured a new term, we generated $8 million of equity recapture back to the fund, we de-risked an upcoming loan maturity, and we did this with minimal transaction cost. So the second case study here is a tactical early refi on our GTA industrial portfolio in Etobicoke and Mississauga. And at the time when we were looking at this at the end of 2021, we knew there was the ability to generate a significant equity recapture just given the inherent cash flow growth in this particular portfolio and the rent growth we've seen in the GTA industrial market over the last number of years. And so looking back, this is, if not one of our most accretive refinancing we've done across all of our real estate funds. So just looking back at the metrics of the transaction, we took the original loan amount of $29 million, increased it to $56.5 million based on the cash flow of the property. We converted our floating rate debt at prime plus one into a new 5-year fixed rate at 2.2%. Like I said, we obtained a new 5-year term. And again, we were able to obtain an extended 30-year amortization. So just tying it back together, looking at the merits of this transaction, we reduced our floating rate exposure. We generated $27 million of equity recapture back to the fund. We obtained an extended 30-year amortization. And again, we de-risked an upcoming loan maturity, which is a common theme. So this last example is something that we're looking to deploy today, which is really a forward rate fix. And so this is a focus for our development portfolio, as I spoke to earlier. And what this is really structuring the optionality to execute a forward interest rate hedge on our construction loans. There's really 4 key benefits here, and I'll just walk through them briefly. The first one is cash flow security, and I've talked about this numerous times on this webcast, but really this is the ability to secure cost of debt for up to 10 years during the hold period. So not just the construction, but also the term or hold period of the property. The second is construction cost certainty. And so what this does, it allows us to fix our rate during construction. So in other words, we have certainty on what our interest cost is during the construction period. Third is flexibility for an attractive entry. And so again, because this is an option, it allows us to enter into the hedge at any point in time throughout construction. So, if we do see a compelling opportunity in the market to lock in the rate, we can quickly take advantage of that. And lastly, the fourth, it really comes down to prudent debt management. Again, this is a way we can mitigate and reduce our floating rate exposure on our development portfolio.
Matthew, real estate debt plays such a pivotal role in the overall performance of our funds, and our investors should take great comfort that we have an experienced in-house real estate debt team that is managing what looks to me as a very well diversified debt portfolio. So Matthew, thank you for your presentation today.
Thanks, Mark.
I would now like to invite Josh Anderson. He will be presenting on development for build to own. Josh's title is Vice President of Development for our real estate team. So Josh, let's start with the first question, and maybe you can tell our audience, why is build to own a good strategy?
Well, we've been focused on build to own within our income funds for several years now. And as the funds have grown, we've brought our own development expertise in-house to help scale and manage the growing pipeline of build to own projects instead of relying solely on third parties or partners to execute on our behalf. And we like build to own for 2 main reasons. Firstly, because it allows us to add value through entitlement and development to achieve stronger returns than buying new and finished product. And secondly, it gives us control. Being able to control the full acquisition and development cycle allows us to dictate where we're building, what's being built, and how we build it. This control becomes very important when we're looking at developments that we intend to own long term, as the decisions made when we're conceptualizing a building, such as the type of heating and cooling and systems or type of building envelope, will have a significant impact on the long-term operating efficiencies or capital requirements of an asset well into the future.
Josh, what are your preferred assets that your team likes to build, and explain why?
Well, our build-to-own strategy has become an important extension of the overall investment thesis of our real estate funds. So for us, build-to-own is a tactical approach to achieving a desired allocation to specific asset types within our income funds. Our in-house development team are working on projects across the portfolio, but our main focus is on developments in the Lower Mainland and Vancouver Island. Vancouver and Victoria are 2 of our biggest markets, but they're also local markets for our development team, meaning we have quick access to any of the properties or municipalities where we operate to deal with local planning departments and any issues that arise. In terms of preferred asset type, our local build-to-hold strategy has been predominantly focused on multifamily, self-storage, and urban industrial. We like these asset types because they've proved to have strong, predictable, and resilient cash flow, particularly in the markets where we're focused.
And finally, Josh, in this challenging economic environment where there's a lot of moving parts, what are the biggest challenges that your team is facing?
Well, it won't come as any surprise to hear that the rapid pace of construction cost escalation and climbing interest rates are making development much more challenging. The volatility has been more pronounced in certain markets and even by asset class, but cost escalation has impacted development across the board. While some trade prices have come off in the past few months, on the whole, construction costs continue to increase, and we think cost inflation will likely continue in the wrong direction for at least the remainder of this year. The positive news for us is that the majority of our current development projects nearing or under construction locally are either multifamily or self-storage, and in excellent core urban locations. Rents in both of these asset classes have been very strong over the past year, and rent growth continues to look promising moving forward. These factors have helped us hedge our development returns against much of the cost inflation that we've seen in the past year.
Josh, keep up the great work, and thanks for your presentation today. I would now like to invite Roz McQueen, who will be presenting on the impact on valuations from leasing and asset management. Roz is our Director of Leasing for the Nicola Wealth Real Estate team. Roz, let me start first with, can you give us a high-level overview of leasing and asset management objectives for Nicola Wealth Real Estate?
So for our two teams, leasing and asset management, to deliver our results, we're really focused on what's called net operating income. Net operating income is essentially the profitable cash flow element from income generating real estate investments. And it's a function of a few inputs. So first and foremost, most people are familiar with striving to get premium rents. That's really a result of a well-executed and targeted acquisition strategy, having selected well-located assets in thriving and opportunistic markets. Then we also need to think about creating predictability for the operating income by locking in a long-term lease with our tenants through our contracts, and then deploying strategies to mitigate our any exposure to vacancy risks, and having visibility on that over the medium term so we're not surprised.
Roz, our real estate team is laser focused on keeping our assets leased. Can you explain why income growth is so important when transacting leases for our portfolio?
Sure. So when you think about income growth and the opportunities that we have to add the value, there's a moment in time when we transact on a new lease and we recognize what that rental rate increase might be, but it's also thinking about the sustainable growth of that income over the long run. And so with our Nicola Wealth Real Estate funds, they really benefit from working with all of those levers that I just explained about the net operating income, dialing them up, dialing them down, making those positive returns, but also making sure in the lease negotiations that we have put in very thoughtful rental increases throughout the lease term to work to limit the landlord's exposure to costs and also give benefit to our investors.
Leasing is a very important area of expertise on our team, and both Sveto and yourself lead that initiative for us. Can you explain to our audience what are the main key areas of focus on lease negotiations?
So in its simplest form, you've got your lease rate and the term, the time period that you have your tenant committing to that rate. But there's really so many other factors that can rise in your lease, the life cycle of the tenant's lease, as well as at negotiation. So these days, what we're really focused on beyond those two basic elements between the leasing and the asset management team is around our teamwork together to execute our strategy, the relationships, knowledge, and experience to create a better lease negotiation process. We really want to create a clear and less complicated path forward so that we can recognize those great results to the net operating income.
And finally, Roz, as you often hear me say, the actions of a sponsor on our team impacts other stakeholders. So let's assume for a moment you are the sponsor. How does leasing impact financing and property valuations. Can you give us a real-world example?
One recent transaction which we just completed is on an asset we've owned since 2019, and we were in constant communication with the existing tenant. We knew they weren't going to be renewing, and so we were able to get in front of that with lots of time before their expiry. Picked up a really strong listing team to be able to execute on our releasing strategy, and we were able to secure a new tenant for a 10-year deal, a $16 premium to the existing rents on a lease, that will essentially result in a 22% increase in value. So we were really pleased to see that. When we see those increases in value, we literally take that lease transaction the moment it's executed and go speak with our debt team, give them all the details that they need to know, and then they can figure out how to take it on to the next step, which is at our lease maturity, which is coming up next year for this particular property. They're anticipating being able to take the new lease and realize over $6 million worth of refinance capability, and take that money and deploy it in other real estate avenues, and really just getting additional benefit for our investors. So, the lease transaction really does translate not just to cash flow increases for our investors over time, but possibly new opportunities.
Thank you, Roz, for your presentation. I would now like to invite Liz Firer-Gillespie, and Liz is Vice President of Asset Management, and she also leads our ESG policy and initiatives. The first question I have for you, Liz, is can you explain to our audience some background on ESG and the standards?
Absolutely. So ESG as a concept, really, it's been around for decades, but the acronym itself was coined in 2006 as part of the UN's Principles for Responsible Investing. And really what those are is a set of 6 guiding values, providing a framework for making more ethical investment decisions. And broadly, it's divided into the E, environmental, and that's when investors are looking at the impact on the environment, including carbon footprint, energy efficiency, waste management practices, use of renewable resources, climate change, etc. Social, it's the relationship with employees, customers, suppliers, communities. You're looking at factors like labor practices, employee diversity and inclusion, health and safety standards, community engagement, customer satisfaction, etc. And then finally, we have the G, which is governance, and that's what's a company's internal governance structures, their policies and practices, their board composition, how do they do their financial reporting, what their ethical standards are, and on. ESG, it's very much an evolving field with ever-changing trends, lots of different opinions of what tax people should be taking, but it's something that we're really very much focused on and include in all facets of our decision-making.
That's a great segue into the next question. Can you outline for our viewers Nicola Wealth's ESG policy?
So Nicola Wealth has an overarching ESG policy, and it's something that really, even before ESG had a formal framework, it was something that we looked at in every aspect of our decision making. So from the real estate perspective, every single investment decision starts with a fulsome due diligence process. We're looking at what's the asset, how is it constructed, who are the tenants. Our due diligence list is quite comprehensive, and the end result is our fundamental question is, what is this investment? How can we make it better? How can we make it more efficient from an energy consumption standpoint, make it attractive to tenants in the respective markets? And longitudinally, we want to be prepared for what trend comes next. So when we're looking at it from the environment, how is the building consuming energy and what emissions is it responsible for? Are there any environmental contamination issues that we'll be needing to address? Socially, we're looking at who our tenants are, what is their business, how do they fit within their community, and how does the building fit within its community? Is this the right fit for this asset long term? And when I look internally, it's informing how we think about our team, what opportunities we provide, how we interact with our partners and stakeholders. And as a firm, one of our core tenets is philanthropy. So how do we support our employees to make the world a better place? And then again, finally, from the governance perspective, it's what checks and balances do we have in place to make sure that we're doing right by our investors? And this starts at the beginning of every single investment when we have our external investment review committee. This is the group that's blessing every acquisition that we're doing. On an annual basis, we're doing external audits to make sure that we're continuing to do everything above board. And then finally, we also have quarterly appraisals for every single one of our assets, ensuring that we're providing fair and transparent values in setting our NAV. ESG, as you look at that flywheel, it's not a moment in time. It's a concept that we're always looking at to ensure that we're delivering best-in-class assets and services internally and externally, now and as we continue to go forward.
Okay, Liz, let's drill down a little deeper. Can you explain what Nicola Wealth Real Estate is specifically doing to measure results?
So, as real estate is a very tangible business, I'm going to focus on an environmental success story. 25 Watline, this is an office building that we have in Mississauga. It was built in 1989. We purchased it in 2017. And again, with our fulsome due diligence process, when we purchased it, we knew that there were some capital upgrades that we were going to have to do, both from an operational perspective and also from a cosmetic perspective. But before we dove into those, we really wanted to take a step back and make sure that we were doing really the right thing by the assets. So we rolled out a utility benchmarking system so that we would have a full idea of how we were consuming utilities. And we were able to use that to sort of inform some of the next steps that we took. And we put together a capital plan where we started off by replacing the old lighting with new LEDs. We installed water flow devices, which enabled us to find some leaky toilets and other places where we weren't using water efficiently. And then most importantly, we replaced old, inefficient heating and air conditioning units. And the end result is that because now we knew when we had our peak utility consumption times, we were able to tweak our operation schedules to make sure that we were using our utilities effectively. The end result of this is actually quite remarkable. On an annual basis, the energy consumption, we have saved enough energy to power 21 homes a year. And that's every single year. On natural gas usage, it's the equivalent of removing 5 vehicles from the road every single year. And we're saving enough water to fill 3.5 Olympic-sized swimming pools. And this is just one case study. We're constantly looking at opportunities to improve every single one of our assets. We're reviewing things annually, and every time a new trend or a new something comes out, we're really taking a look at it to make sure that we're prepared for whatever the market is going to ask for next. And the end result is we're always looking to deliver those consistent results that have great space that our tenants want, and also importantly, we're returning good value to our investors.
Thank you, Liz, for your presentation. I'd now like to invite Wayman Crosby, and he's Executive Director of Nicola Wealth Real Estate and member of our investment committee. But before I start with the questions for Wayman, I thought it'd be helpful if I give a bit of background on our investment committee. It was established approximately 10 years ago as we started to see our rapid growth. And now, fast forward to today, it's comprised of 4 experienced industry experts. Not only does the investment committee provide the required governance, it also reinforces the accountability for our entire real estate team. So Wayman, let me start with our first question. Can you explain to our audience what role does the investment committee play for our real estate team?
Thanks, Mark. Thanks for having me on. I think succinctly 3 areas. One is that we're external. We're wise and experienced with real estate expertise. And I think that's a valuable contribution. I think secondly, we review the acquisitions and dispositions for each of the funds, which provides a level of accountability, as you mentioned. And 3, provides a level of separation between the team preparing and approving the projects. And I think that that's an important step, because sometimes people that are close to don't always see things that people from the outside with a fresh perspective can bring.
touching on my opening comment, can you explain how the investment committee contributes to good governance for not only the real estate team, but our clients and investors?
Sure. The first thing I think, as I touched on earlier, is risk management. The level of depth and experience that we bring as 4 independent advisors. I think the second is a disciplined approach. Your team is phenomenal in the package that they prepare, and that discipline, I think, results in improved decision making, which I think is the third point. And I think an important thing for clients to appreciate and recognize is that we're looking at deals from a client perspective. Being external, we have nothing to gain from approving or disapproving deals. We look at them, we evaluate them, and for the benefit of clients, all 4 of us have to agree before we move forward on an acquisition or a disposition.
Wayman, what kind of information does the real estate team provide to the investment committee?
I think the biggest thing is it's a comprehensive package, and clients don't try to delve into the detail on this particular slide. I think it's just more of an overview. It shows a bit of the information that this real estate team prepares. So they focus on strategy, how the deal is being structured, and a disciplined underwriting process. It looks at the downside risks and the mitigants. It does a portfolio analysis. What's the contribution that this particular asset brings to the overall portfolio in terms of geography and asset type and location? And then we look at value, comps, and assumptions. We've got, within the real estate team, people that are experienced with valuations. So they're looking at the valuation of the acquisition. There's a SWOT analysis that goes on, strengths, weaknesses, opportunities, and threats, which are looked at. If there's a new partner, there's information about that partner. And one of the things that I like at the end is, why the team likes the deal.
What are the areas of focus for the investment committee when you receive the packages from the real estate team?
I think one of the first things that we look at is this deal inside or outside the areas of experience and expertise. We often refer to rinse and repeat. Is this a rinse and repeat, or is this a new market, a new partner, a new asset type? So we really look at that first off. If you're coloring inside the lines, inside the box, it's a pretty straightforward process. Where it gets more complicated and where we really focus in, is this something that's a little bit outside the lines, or is there some risks and assumptions that we're maybe questioning, again, as experienced real estate investors, that maybe need to have a little further due diligence. We're reviewing the areas of critical thinking that have been used to prepare the package. Is there any additional due diligence questions that need to be asked? And we evaluate the proposed execution strategy and the timeline. Is it realistic? Particularly in this kind of environment that we're in right now, does it make sense with the length of time that you're experienced for lease up or for refurbishment or for construction? So we look at those assumptions and the timeline and say, is it really realistic, both today and going forward into the future?
And finally, Wayman, what is the value add the investment committee brings in this current challenging environment?
I guess the biggest thing, if you look at our gray hair, we've got 30 to 50 years experience. We've been through multiple cycles. We've seen the ups and downs. We've seen high interest rates. We've seen inverted yield curves. We've seen markets just all of a sudden stop. So we bring that kind of critical thinking, that experience, that expertise to the real estate team to hopefully help them make good decisions following a disciplined approach and asking hopefully some good questions. One of the things that I've seen over the last 10 years is the quality of the packages that have been prepared. And I think some of that's as a result of the kind of questions that we ask. I think your team is really good at now anticipating and trying to put together a package that we have few questions, that they've anticipated what the questions might be and already provided us with answers to those questions. So I think that's a value add. The discipline, the accountability, the externality are things that I think makes for a better, overall result for the real estate team and for investors.
I think, Wayman, you're absolutely right. The questions you and the investment committee asks us, we look at the great challenges, and it makes us better, and that has contributed to better packages and presentations to the investment committee. Wayman, you were one of the 5 original founders of Nicola Wealth Real Estate, so I want to thank you for your valuable contributions over the 20 years. It's hard to believe we're coming up to that milestone, and thank you for your presentation today.
Thank you, Mark. It's always a pleasure.
I'd now like to invite Ron Bastin, who is Vice President of Acquisitions, focusing primarily in Eastern Canada. And the topic for Ron will be really talking about our real estate team, and we've got a case study to reinforce how the collaboration by our entire group. And Ron, every property requires a contribution from multiple team members. Can you walk us through a real live example of how the various team members contributed to a specific project?
Sure. Thanks, Mark. In short, team really is essential when it comes to the success of a project. And when you look at our team, I think it truly is our competitive advantage. It is what others would call our secret sauce. So, we really have a deep bench. We have, we're vertically integrated, and, we have specialists across various disciplines. And our approach is very collaborative at the end of the day. When we acquire properties, when we develop properties, or when we manage a property. So I know a lot of different groups say that they do that. I can speak from personal experience that not a lot do, or if they do, certainly not to the extent that we do. So, if you want to use 601 Milner as a case study, I think that's probably a really good example of how our team works together, our various disciplines. So on the slide here, you see 601. 601 is located in Scarborough. It was acquired in April of 2021. It is an unbelievable property. It's 20 acres, 1,400 feet of frontage along the 401, which is, one of North America's busiest roads. And really, when we bought this, we bought it for its future redevelopment potential. So if you look at the top left-hand corner of the slide, you can see that when we bought the property, it was already improved with an old office building and warehouse building. It was predominantly vacant. There were a few tenants there, and not functional at all. And so fast forward to today, and you can see that we've taken the building down, and which you can see on the top right hand side. And in the bottom 2 pictures, it really depicts what we're going to build there. So it's going to be a new generation 351,000 square foot modern warehouse distribution facility. So at the end of the day, the $1 million question is how does the team come together to ensure success of a project like this? I think that this flywheel that we have up on the screen here does a really good job of explaining how the teams approach to various investments. So if we start with the investment team and go clockwise from there, the first thing that we look at when we look at an investment is we complete a detailed underwriting of an investment opportunity. And what's important in that process is that we actually draw on the different disciplines within the group. So, we draw on the leasing team, on the asset management team, the development team, the mortgage procurement team. Our investment team then negotiates the agreements, and then once it's under contract, we move forward and complete our thorough due diligence on the opportunity. Yet again, using the various disciplines or leveraging off the various disciplines within the group. Moving clockwise, you look at is the mortgage finance team. I think what's key here really is the way that the team can leverage its relationships to ensure, that we can procure and secure attractive financing. At the end of the day, in Canada, we have, in and around 35 different lenders that we deal with. So that does provide us really good insight and ability to secure good financing. And if you look at it in relation to the Milner opportunity, when we closed on the asset, we secured land financing, and then subsequent to that, we secured pre-construction financing, which was for the period of time that we did the demolition, as well as went through the entitlement process. We're currently out in the market right now looking for construction financing as we begin the construction, and then when that's done, the mortgage team will then go out and secure long-term financing. So pretty involved in the process. Moving on to the insurance, I like to say a lot of people don't realize how important insurance is, Mark. We have an in-house specialist that their role really is to protect us and ensure that our properties have adequate insurance, that our partners have adequate insurance, and frankly that our tenants have adequate insurance. So it is a key component of it. When you look at the asset management, a lot of people think that that's it is one of the main components. I say asset management's where the rubber hits the road. So asset management is really deals with the ongoing operations of a property. So, when we look at it in relation to the Milner transaction, asset management got involved at the very beginning, and they were essential there to ensure that we maintained as much income as possible prior to the demolition with the few tenants that we had. But what's also key is that they're involved through the development process, because we want to make sure that when the development is done, that there's no surprises on their end with respect to our property. Then leasing, I think leasing is extremely important as well, obviously. Very involved throughout an entire process. In the initial underwriting, they want to, ensure that the pro forma rents that we use are achievable at the end of the day. Leasing is involved with engaging the listing team and overseeing the marketing efforts. They're responsible for responding to RFPs for potential tenants. They oversee, along with asset management, they oversee all lease negotiations. So not just the financial side of it, but also the non-financial side, where you just want to make sure that we're not getting caught or tripped up with a special provision that a tenant might want. So again, leasing and asset management working hand in hand in that situation. Leasing also on the development side is really key or important, if you want to say, because they help with the overall design of the building. So, it's great to build a nice building, but if at the end of the day you can't lease it, the project doesn't work. So they ensure that the buildings are leasable at the end of the day. Our development team, really the development team is there to oversee the construction process, the selection of the construction manager. They do the tendering, they do the contract negotiations. They're actively involved in our development underwriting when we buy a property like this one. And I would say, the development team really is there to make sure that the project is built on time and on budget. And then, finally you get the finance accounting team. They're really there to do all the reporting to ensure that our NAV is accurate, that the property returns are are calculated and that they're reflected in the overall fund returns. And we actually, the accounting team is actively involved when we're looking at larger lease transactions and underwriting the covenants of potential tenants. So again, you can see that through the whole process, every team or discipline is actively involved, and we believe in our process that that's truly the way that that you can ensure a successful project at the end of the day.
I love that flywheel for the real estate team. And Ron, 601 Milner is just one of the many great examples to showcase how all areas of expertise on our team and how they need to collaborate to achieve a great result. Ron, thank you for your presentation.
It's great. Thanks.
I'd now like to welcome back Alex Messina, who is Vice President of Acquisitions. Alex, in this new challenging environment with the rising interest rates, it has definitely changed the landscape. What do you see as the main challenges, and where do you see the opportunities going forward?
Well, Mark, there are definitely more challenges in this current environment compared to, say, 2 years ago. I think I should tackle the big one right away, and that's interest rates. It's pretty clear that rising interest rates are posing challenges for real estate. Rising interest rates, capital constraints, they actually go hand in hand. The cost of borrowing is up, mortgage loan amounts have been reduced, deals require more capital. Carrying costs on development projects have increased as most land and construction loans are variable. And again, projects require more capital. And of course, cap rates have started to increase. Compared to, say, 24 months ago, capital is now at a premium. So overall, this doesn't really sound like great news, but this current environment has actually created some interesting opportunities. Many buyers have been pushed to the sidelines. Transaction volumes are down significantly. This makes for an opportunity to acquire assets with less competition and often on improved terms. Although this doesn't necessarily mean more attractive pricing, but in some cases where sellers have immediate liquidity requirements, shorter terms can actually translate into favorable pricing. I would stress, though, that the devil's actually in the detail. Certain asset classes are more impacted than others. For example, industrial assets, self-storage, multifamily assets, those have been less impacted than, say, office assets. And I think that's why fund composition is so important, as we discussed earlier. The asset classes that have strong rental growth potential are going to continue to be sought after as they're going to be more resilient in a rising interest rate environment. The reality is that there's been a flight to quality in almost everything we do. Lenders are being more selective with the borrowers they lend to. We continue to have good access to debt given the strength of our balance sheets. Developers are being more selective with the capital partners they engage with, and better assets are commanding a bigger value premium. All of this bodes well for our real estate funds. The strong closing track record our team has established means that we are an easy call for brokers, while many other buyers have their pens down. We continue to actively acquire properties in this environment, although it is at a slower pace. So we are getting to look at a lot of interesting opportunities. The bottom line is that capital is king right now, and those that have dry powder are going to have better access to interesting opportunities. So maybe I'll switch and talk about government regulation and the impact it has on timelines and ultimately costs. Government red tape is particularly impacting residential development projects. We hear a lot about this in the media, and the media sensationalizes the acute housing shortage in Canada, yet fails to recognize the challenges imposed by multiple levels of government. As we highlighted in this session, we have a dedicated build-to-own strategy where we're developing purpose-built rental apartment projects in both Vancouver and Victoria. Approval periods to secure entitlements continue to increase as municipalities are clearly not equipped with the resources they need to handle this vast volume of development applications. These entitlement periods now take upwards of 48 months before construction even starts. So time is the ultimate enemy, and when it takes 6 to 7 years to complete a project, it's not surprising there's a housing shortage. These longer timelines, along with the added impact of higher interest rates, means the total costs of delivering new housing are going up. And there are also a number of other costs layered on by government. At the municipal level, this comes in the form of development cost charges and levies, all the way up to the federal level. This includes the GST that must be paid on the completed value of the rental projects, even though we're not actually selling the finished product. So where in this is the opportunity? Canada continues to experience tremendous population growth, which in turn will only increase demand for housing. And this is why we are bullish on the residential rental sector. We see continued runway for rental rate growth and recognize there are major barriers to new supply, as I mentioned. As a result of higher interest rates, higher equity requirements for projects, and higher construction costs, we're seeing a number of projects being paused. This is not just for multifamily rental, this is also for industrial projects. Meanwhile, we are pushing forward with our projects on our build to own. We believe that they're going to benefit from less competition when they complete. As I mentioned, time is the killer and all capital has an opportunity cost. The longer a project takes, the more pressure there is on returns. So how do we navigate this? In this environment, we're more focused on deal structure. We're looking for ways for our capital to be more efficient. And what this means is structuring deals where we make commitments, but do not actually fund our capital until closer when a project is ready to start construction. That way, our capital doesn't need to work as hard. A great example of this is a joint venture we recently completed, where we're going to construct a 267-unit multifamily rental project that we will keep long term. By the time the transaction closed and our capital was deployed into the deal, the building was already well under construction. So by taking this approach, our capital will be much more efficient, given it's not sitting around for years while we secure approvals. The last comment I want to make is that there's always going to be challenges in any environment. The key for us is that we continue to adapt our strategies so we can remain active. Our goal continues to be to uncover attractive investment opportunities despite market conditions.
Thank you, Alex, for your presentation. This concludes our 2023 mid-year webcast reporting on our 3 real estate limited partnerships. As you can see, we're very fortunate to have an experienced team members who are very passionate about the results for our investors. As I often say, it is the 1,000 wins throughout the year that all add up to producing strong results. Every little win matters. These are challenging times in this current high interest rate environment. With the benefit of working for over 40 years in the commercial real estate industry, I've experienced many economic cycles. And one thing is for sure, nothing stays the same for an extended period. I also know that real estate does not run on its own. It requires experienced people. And it gives me great comfort that I get to work with such an awesome group of people every day. Our team was prepared for this current economic environment and are up for the challenge. I am confident we will get through this difficult period. If you made it this far, thank you for listening. And for our investors in our 3 real estate limited partnerships, thank you for your loyalty and having faith in our team. And finally, to learn more about Nicola Wealth Real Estate, you can visit our website at realestate.nicolawealth.com. It features announcements and press releases on noteworthy milestones and accomplishments. It also provides access to our quarterly reports and past webinars, plus a full summary of our assets and markets we are invested in. Thank you for listening.